Hey guys, before we get started, I wanted to let you know that this is part one of a two-part interview with Adam Chaucer. You know me, conversations run long sometimes. So let's go ahead and get to it then, shall we? Enjoy. Welcome to the Plan B CRNA podcast. I'm your host, Bobby Jones, and I'm so excited that you're here. The Plan B CRNA podcast is the only show made specifically for nurse anesthetists who are exploring options outside of their traditional career paths. This is the place to expand your mind and your goals as we uncover new ways to produce side income together. Join me for some honest, unscripted discussions with other CRNAs who are transforming their financial lives. This episode is brought to you by On-Call Capital. On-Call Capital is dedicated to educating CRNAs and other healthcare providers about investing outside of the traditional stock market. On-Call Capital also provides opportunities for you, yes, you, to create passive income and generational wealth while also lowering your taxable income through investments in the apartment and alternative investment spaces. If you haven't hit subscribe yet, make sure you do that right now so that you don't miss an episode. Thanks so much for joining me today, and now on with the show. Welcome to another Provider Spotlight episode of the Plan B CRNA podcast. I'm your host, Bobby Jones, and our guest today is a CRNA from Fort Worth, Texas, who has a passion for educating others in the benefits of investing in venture capital. Adam Chaucer is an experienced business owner and successful investor in private companies, covering a variety of sectors, including biopharma, biotech, e-commerce, financial tech, education, healthcare, artificial intelligence, space transportation, cybersecurity, and Web3 and blockchain. He truly has a passion for educating others on venture capital, as well as financial independence to allow others to maximize their earnings and their charitable contributions. This passion led him to create agcollectivecapital to educate accredited investors and provide access to investment opportunities for above-market returns in early-stage private companies. As founder and CEO, he oversees the sourcing and evaluating of deals, due diligence, capital raising efforts, investor relations, and portfolio management. That's a lot on your plate, Adam, and I'm so happy to have you here today. Welcome to the show.
Thank you, Bobby. I appreciate it. As you said, this is something that I have a passion for. Honestly, I never really thought this was the direction that I was heading, but it just kind of, I don't want to say fell in my lap, but you take a step back and you start seeing the little steps that kind of led you to where you're going. And so this is something that I love doing, again, that I'm passionate about and that I like sharing with other people to educate them and also, invite them to join in on some of the deals that we do. So hopefully, they can gain financially from all the stuff that we're involved in as well.
No, I think this is a topic that you just don't think about regular people being involved in. It's something that you think about like big wig financial advisors and these hedge fund managers and stuff. Those are the people that are involved in this stuff. So, what I want to know is, how did you first get involved with this? What did that look like?
Yeah. So before I ever got involved with it, I felt exactly like what you just said. It's like, this is for, those sitting in the corner offices in the huge towers, New York City, or, your big financial districts. And there are those for sure. You hear some of the big venture capital companies, and they're doing some great things. There's huge amounts of money coming through there. And so, I was kind of aware of that, but it's like, how would you even get involved in that? And so it was something that wasn't even on my radar at all. I've been blessed in my anesthesia career just over the years to work in a lot of different places with a lot of different people. And what's really cool is you never know where, some of those relationships and some of those discussions are going to lead you. And so I met somebody probably, maybe 10 years ago. And we were discussing some investing things, and he's like, "Hey, I've got something coming up here in a few years." And he's like, he's like, "Reach back out to me because this is going to be some good stuff." And so several years went by, I kind of forgot about it. And then I left the hospital that I was working at, ended up going back and working there for a little small window. And I ran into him, and he's like, "Hey, remember that opportunity we discussed?" I was like, "Yeah." And he goes, "Now's the time." And so, basically, I didn't know a whole lot about it at the time, but I was like, he's piqued my interest here, And so there were some investor meetings and dinners that I attended, and basically this opportunity I'm speaking of was with a group of guys that were highly successful. They had had multiple companies that they grew and sold for multi-billion-dollar acquisitions. One of their companies was called Adams Therapeutics, which ended up being Mucinex.
Oh, okay.
Mucinex. So they actually they designed that line of products and sold it for $2.2 billion. And then their next company they started a few years later, and it was a drug to protect against hyperkalemia. And they sold that company for $2.7 billion. So I was like, now you've got my attention. Those are some big numbers.
Yeah.
And if I can get in on an investment with some guys that have a proven track record, again, some of it's stuff that we've seen like on the shelves. One of the guys involved in some of those companies helped develop Nicorette, the chewing gum. So I was like, man, I've heard of all of these, so you're telling me I have an opportunity to get in on like their next thing. I can get in on the ground floor when the company's early and valued low, put some money in it, and over the years as that company progresses and hopefully either goes public or gets acquired, you're telling me I can make like significant amounts of money off of that. So it was a leap of faith. I knew a few of the people that were kind of involved, but there's always a lot more people involved in these things, than you could imagine. And so the guy that kind of brought me in was a buddy of mine. And so just over the years, started going to different investor dinners, and you would hold like town hall meetings on Zoom meetings and stuff like that. And so just over the years, kind of around those type people more, and different deals would become available to participate in. And so as we were kind of getting into it, I was like, man, this is an area I never thought was possible to get involved in. Like it's kind of an area you almost have to know somebody to open the door to let you in, because it's all these are private companies. Like, so it's not something you can look up on the stock ticker and pick it out and purchase your shares of stock. You have to basically have access to the deal. And so to have access, you generally have to know somebody, to kind of bring you in. So that's how we got started.
Yeah. So I think it's important though that you mentioned how you started to be in the room with people who were investing in those kinds of properties, and that speaks to surrounding yourself with people who challenge your preconceived notions of what these types of investments might be. Um, Getting a little bit more into your investment experience, how did that actually change your investment philosophy? What did you see as an evolution over that time period from then to now?
Yeah. So we had, like probably most people do, we would contribute to our 401k each month. Occasionally we would find some, stocks that we liked or something and contact our financial advisor. We have several other investment accounts that we would kind of put some money in. We've always had a an idea that we want to do some like alternative investments. Growing up, my dad always had, kind of side investments, whether it was different stocks or bonds or whatever. And then, we kind of got into some oil and gas stuff probably 15, 20 years ago. Invested in a tequila company that was a startup that was a friend of mine from CRNA school. And so we kind of did some different investments, but it was a little kind of scattershot, something here, something there. And so when this came about, it was like, initially I was like, man, I don't know about that. Like the hard thing is you can't, there's not a lot of research you can do on these companies in general because they're private companies. So, when you go to Google and type in stuff, you might be able to find some things depending on how far along the company is. A lot of them have websites, some of them don't if they're really early. But it's hard to really do a deep dive into it, especially if it's really early stage company. And so, there's reasons for investing early stage versus late stage and kind of in between stages and stuff we can get into in a little bit. But, the early stage ones, it's a little bit of a leap of faith. You kind of have to trust the person that's bringing the deal to you and kind of read the information that is disclosed, because there is information that's shared. It's just you usually don't have a 2-year or 4-year or 10-year track record on these companies. So our philosophy kind of changed because we were kind of taking the slow and steady route, which I still think it's important to have investments in that lane. But I'm a firm believer that you need to diversify your investments and have, private investments, public investments, um, you know, slow and steady, your fast and furious or your risky investments. And so when we were taking a look at this, it's like for the amount of money that we were investing, and don't get me wrong, it's not an insignificant amount. Like I think all of us work really hard for our money, and it's very hard to part with it. I'm in general not a spender. I'm like highly analytical, so I research things for a long period of time, and then it may take me 5 years to buy something. And my wife's the opposite. She's very like impulsive, and which is, in my opinion, it's a good thing. Like she's kind of brought me closer. Like we kind of balance each other out. And so, because of that, I found like, I can get caught up in analysis paralysis, and you're really diving into it so much, and your fear is holding you back from doing something that's out of the ordinary or doing something that everybody else isn't doing. And when I really took a step back and looked at that, it was like, well, why aren't people doing this? And in general, people that I knew weren't doing it. Number one, because they didn't know about it. Number two, they didn't have access to it.
Yeah.
And so when I looked at the amount of money that we were putting up to be involved in these deals, and I looked at the potential returns on them, it was a no-brainer. It's like I can keep kind of going the slow and steady route, or I can take some chances that can catapult us and potentially provide some generational wealth opportunities.
So let's talk about that a little bit, because obviously there's some additional risk in investing in these companies. So at what stage are you looking at investment with certain companies, and what are some of the risks involved? How do you mitigate those risks that are involved? Because I would think that's a big factor in why people would be hesitant to invest in startup companies, because you don't have that track record, and you don't have some of the documentation that more established companies would have. So how do you mitigate that risk?
Yeah. So a couple things. Number one, one of the big differences in public companies and private companies is when you invest in the private companies, your investment is illiquid, meaning it's basically tied up in that company. Your investment is honestly worth nothing unless that company goes public or is acquired. And so that can be a scary thing because for somebody that's putting money in, it's hard to continue putting money in various companies and you're not seeing anything back. I know with apartment syndications like you do, and some other investments, you may get dividends or disbursements. That's not the case with this. And so when you're putting money in, you're wiring that money to an account, and then like you're kind of kissing it goodbye. But hopefully, I don't think anybody makes an investment like knowing that company's going to fail. I mean, that'd be a horrible investment. So, the hope is that several years down the road, that money's going to come back, many times over. Kind of fast forward just a little bit, there's a lot of venture capital companies, and they tend to focus on particular phases of startup companies. Some are early stage. Most of what we do is early stage. There's some that do late stage, and late stage only, kind of a growth phase. And so those big VC firms, there's different amounts of money that are involved in each. And so for those late stage investments that some of the VC firms kind of specialize in, they may put 100, $200 million in a late stage. But at that point, the companies are kind of de-risked. They're far enough along that they do have like, proven sales or month over month, increases, or where they have a track record. When a VC firm goes in that late, the potential returns are a lot smaller. They may only get a 2 to 3x return at that point. So they're putting up huge amounts of money, but it's smaller returns, but the companies are also, de-risked to an extent. Early stage is kind of completely opposite. Early stage, a lot of these companies may not survive, and that's one thing with investing in private companies. You have to know that a lot of companies won't survive. If you like the bulk of your returns and the money that you gain is going to come from your top couple companies. So if you invest in like 10 companies, there's going to be one or two that are kind of your bell cows, that are going to make you all your money. There's going to be, two or three more that are going to be, pretty significant returns, but more in like the 5 or 10x range. There'll be a couple that may return 1 or 2x, and then there'll be several that just fail outright.
Mm-hmm.
And so that's a given. And so that's why it is a risky endeavor, but if you invest in enough companies, you're kind of mitigating that risk. And the more you invest in, the greater likelihood that you have of having, those returns that you're seeking. There was a study, I can't remember who did this study, but they said if you invest in, I think it's over 25 companies, you have like a 90% probability of returning 30% annual returns on your investment. So pretty good odds. I mean, I like those odds. So
Yeah.
the more you invest, the greater probability you have. So the same study found that if you invest in over 45 companies, which sounds like a lot, but if you invest in over 45 companies, you have, I can't remember if it's 95 or 98% probability of achieving those returns. So basically what that tells you, is if you're just you're picking out single companies and you're, putting all your money and your, hope in your finances changing significantly in those one or two companies, you're either going to hit it big or you're going to fall, flat. And I think there's a lot of people who are like, I've known some people that have invested in private companies and it's never worked out well for them. And there's a Kairetsu Forum, I think is what it's called. It's like this big angel investor network, which angel investor, venture capital, private companies, like all that, they're similar terms. They mean different things, but they're kind of grouped together. They did a study and they polled all their members, and everybody basically said, they knew that it took investing in a set number of companies, to achieve the returns they were looking at. But most of them failed to kind of hit that number, and they failed to do so because of access to deals or because of the amount of capital it was going to require to participate in those deals. So again, in a little while, we can kind of talk about some of this, but there's something that we're doing to kind of invest in about 20 to 25 companies a year. And so if you look at that, and based on what we just talked about, you gain access to all these companies. So you're kind of spreading your money and spreading the risk around on all these companies. So like myself, we probably have maybe about 35 companies or so that we're currently invested in, which it took a little time to get there, but at the same time, I feel really confident not just having all my money in one or two companies.
Yeah.
When we started out, we had access to some of those deals, with some of those guys that have a proven track record and been there and done that. Kind of putting, bigger dollar amounts on fewer companies. And then, I had somebody that I was kind of working with and kind of became a mentor to me. And we kind of put our heads together and decided to do something. And, again, that was a game changer for me, because instead of just kind of putting most of our money on a few companies, we're spreading out our money on a lot of companies. So, now we have a lot of irons in the fire, and a lot of shots on goal to be able to get those returns that we're looking.
So, when you're looking at a particular company to invest in, what are some of the key things that you're looking for? Because obviously, if you've got, maybe a 50-50 shot of this actually, being a legit company that's going to produce returns, like half, and I don't know what you can correct me here. I'm guessing, like half the companies don't work. Half of them will produce for you at some point and they make up each other, but I could be completely wrong on that. But, point is, what are the key things you're looking for, and how do you know when those metrics start to change?
So, what's interesting is a lot of these companies, some of these companies may never ever be profitable. A lot of the healthcare companies, if they're developing a drug or something, they may never ever see profit before they're acquired. But their studies and their trials and everything are so, have such good results that a larger company, wants to acquire that company and bring them into their portfolio. So it's funny because sometimes, you're like this company's not even, they're in the negative, but then they get acquired for, a couple $1 billion or whatnot. For me personally, some of it is just the players, the CEO and the CFO and some of the people that are running these companies. If it's a group of people that are kind of doing it for the first time, and that's very different than if you have some seasoned people who have grown companies and been part of successful acquisitions. So just having people that know those fields, have the connections, in whatever, whether it's the pharmaceutical world or whether it's robotics or whatnot, like having the right connections there. The other thing is a lot of these companies. My partner, he was saying he was part of this incubator in California, and their motto was like, don't be the first don't be like trailblazer, basically. Like, find a product that someone else has done and identify the issues, that they've faced, and basically be a better version of that company. So, let someone else blaze a trail and then come in behind them with a similar but better product. It's easier to sell to people or explain to people because it's not a new category. It's something that someone else has done. And basically you can learn from their mistakes and fix that and, push out a better product. So, some of it's that, some of it's just where the deals come from. So a lot of the deals that we do are from an incubator called Y Combinator out in California. And it's the most successful incubator of all time. Some huge companies, that we've all heard of are out of there. Dropbox, Stripe, Reddit, Coinbase, I think DoorDash, Airbnb, just, the list goes on and on, just these monster companies. And so again, my partner, the other thing about this is, surround yourself with people that are good at what they do and knowledgeable about what they do, because there are so many pieces to it. So I'm fortunate enough that I have a partner in this that he's an investor. He's a founder of a company. He has his own company that he's the CEO of, and it's a private company that he's trying to do stuff with, and he's got a lot of really good connections. And so through his many connections, we have access to these companies at Y Combinator. And so we invest in several of those each year. And so these again are top-notch companies that are kind of going out there and being molded by Y Combinator and getting access to all the things that they've done to help other companies grow in the past. And so through that, he has a lot of conversations with those companies, and I'll jump on the phone sometimes with them as well, and basically talking to these founders and finding out what kind of company they have and getting some of their numbers and stuff like that, and then kind of whittling that down to decide on which companies to invest in. So, we have an investor in one of our companies, and he's a founder of a company as well. And he said, I've been to Y Combinator. I took my company through it, and he said, I've got the T-shirt to prove it. And he said, if you're looking for a good source of deals, he's like, I think that's a fantastic place to start. And this guy's company, he goes, we learned from them. We took some of their advice. We kind of went our own route on certain other things, but now his company's worth over $1 billion. And so he's like, I highly recommend if you have access to those deals, like it's a great place, to tap into. So just feel, very fortunate that, but there's kind of multiple routes, that where some deals kind of come to us and stuff. But one of the big kind of difficult to tap into, but one of the areas that we have access to is Y Combinator.
Okay. Now, when you talk about an actual investment in something like this, you're talking with investors who are interested in getting into these kinds of offerings. What is an initial investment look like? What does it look like to you? What are you typically asking for, and what does that entail when you get that financial commitment from somebody? Where does that money go?
Yeah, absolutely. So, for some of these companies, for some of the early stage companies, they may only be looking to raise 150, 200, $250,000. The later stage that they get, the more money they're raising. So it really just depends on where they are, what they're looking for. A lot of times, basically for somebody that's just coming in and doing an individual investment in a company, you're generally looking at a minimum of probably about 25,000. Sometimes it can be as small as $10,000, but it just kind of varies. So, again, if we're going back to investing in, over 25 companies or over 45 companies, like that amount that's a lot of money when you're talking about, say $25,000 in each of those companies. So, we have what's called a rolling fund. It's through AngelList, which is this online platform, really, really great platform. And so with that, we're doing, about 5 companies a quarter. And so for that, like, let's say, Bobby, you're like, I want to participate in this third quarter of 2022. The minimum is $10,000. And so that $10,000 goes into a fund with other investors. And that your $10,000 in addition to everybody else's money is then spread out amongst these 5 companies for that quarter.
Okay.
So that's what's really cool, because here you're getting access to some high level companies. I say high level companies, some companies that have been kind of picked out of hundreds of companies for us to invest in, and instead of having to put up 25,000 on each company, let's say yours is like 2,000 per company, because if we do 5 companies and you put 10,000 in,
Yeah.
so now you have access to all these different companies. And then when the next quarter comes around, you have, option to do the same. There'll be 5 new companies. So each quarter it's different companies. Sometimes we kind of follow up in subsequent quarters with some follow-on investments and some companies that we previously invested in. Usually those are the ones that have, month over month growth and really good sales numbers, or, have some announcements they're going to make pretty soon that's going to kind of catapult those companies. So we go ahead and put some more money in it while we can. But for the most part, we're kind of doing new companies, because we're really trying to focus on that early stage, like pre-seed, seed stage, Series A, because that's where the greatest returns are. There's a lot of risk, but you're also getting in so early, and the companies their valuations are lower. So, if they are successful, you're looking at some really significant returns.
So let's talk about that a little bit. You've obviously had some winners in your own portfolio. What kind of returns have been the best that you've seen, and where has it kind of averaged out?
Yeah. So again, it all depends on, how early you get into these companies. One of the companies that I'd kind of mentioned earlier, the investors that got in kind of early on that, they realized a 48x return on their investment. Yeah, that's kind of what got my attention early on. I'm like, oh my gosh, like that's like, are you serious? And so I know some people, like I've talked to them, I've had lunch with them, I've can touch them. It's not just like you hear of it, but you don't know anybody that actually happened to. So it's good, when you can actually talk to someone who's been through it and experienced it. And that's not one of the founders. That that was one of the investors. Now that same company, there's people that got in later, and I think their returns were more like 15 to 20x, which still
darn.
yeah. I know. I'm like, I'll take that all day long. So again, it really depends. There's my partner Chris has a company. It was called Scanwell Health that was acquired. I forget who acquired it, but it was an at-home like COVID testing company, and that was part of a fund. And there was 4 or 5 companies in that fund, and that one company returned the whole entire fund. So basically, everybody that's invested in that, got their money back. And then now there's 3 or 4 other companies that they're just kind of right. And they're playing with house money at this point on those companies. So, some of them may take a while longer, but anything that comes back now is just straight profit for them.
Yeah. Well, and that's what you want, are those infinite returns eventually, where like you said, playing with house money, you've already made your money back and you've got it in hand. So whatever you get on top of that's just gravy. It's clear after speaking with Adam that there are some great opportunities available in venture capital. Risk is really relative. It depends on the individual and the situation, but too often we view risk as something to avoid altogether. But risk doesn't have to be a bad thing, so long as you have a systematic approach to those mitigation techniques. That's going to do it for this episode. If you're interested in reaching out to Adam, you'll find his contact info in the show notes. Make sure you join us next week as we dive further into Adam's investment mindset and his future plans. Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by OnCall Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find OnCall Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.